all the gains. Nirav Sheth of Emkay Institutional is joining us to talk more about that. Nirav, afternoon. Thank you so much for your time. Do you think that this time the market will oblige with the much anticipated and expected action of a meaningful nature?
Well, we need to define meaningful. So, if you are looking at a drawback of which is more than 10% or something thereabouts, unlikely. Do you have normally corrections along the way, which are very difficult to predict? Can it happen? Of course. The trigger most likely could be obviously around the surge in Brent oil prices, and that has implications, and more so for India. Uh, the key question, Ajay, is that are you positioning yourself to buy into the corrections? Is it a buy on dip story or is it a sell on rise story? There the conviction is fairly clear. You don't want to miss the wood for the trees, right? So when you look at the next several years, this is a long journey, Ajay. There's no point of trying to preempt this 2, 3, 4, 5% corrections and getting obsessed around it.
Fair point. You are very right about it. Tell us about the areas which you are bullish on, where earnings quality, underlying strength is there. Whenever there's a pullback, it will make valuations much more attractive.
Uh, uh, what defines the new India right now is the fact that over a long time, and I'm talking about this is probably the last time we saw this was in 0304. I remember very distinctly that we're all excited about divestments, and then suddenly that was pulled under the rug and the markets went down, and then it had a life of its own because the economy took off. I think that there are three levers to any investment cycle. So you've got infrastructure, which is largely, let's say, the state and the government, and there could be multilateral agencies. The second big piece is real estate, which in India's case is close to about 9 to 10%. And third, which has invariably appointed for a long, long time, has been corporate capex. I feel supremely confident of making, shouting on the top of my voice that you'll have a very, very strong investment cycle with all the three legs contributing. You are just at the cups of what is happening even in the corporate capex cycle. And let me dwell a bit on that. So please understand that there are two ways the corporate capex cycle can happen. One is obviously a prerequisite is that you need to have a surge of profits, which we have seen. The utilization levels goes up, and therefore you need to expand the capacities. This time there is an extra leg to it. So you've got major disruptions that is happening. So when you're talking about the green capex, when you're talking about electrification, when you're talking about green energy, a lot of this capex has to happen irrespective of whether you got ROEs or not. So today, for example, if you are an incumbent automobile, you have to invest in electrification, right? If you are into this entire sphere of this renewables and all, you don't have an option because these are all existential problems, right? Global warming is a reality, and this is not only of India; this is a global phenomenon. So all these things are sinking in, and I'm not even talking about the PLI, China plus one, now Europe plus one. The list goes on, Ajay.
Right. One last word I want to understand from you, Nirav. What exactly is happening? There is dollar index at 107, US bond yield highest in 15 years, crude at Brent at 95, but still Indian equities are holding up. In this kind of a scenario, we should have been down 10-15%.
So two things. So first of all, we also need to understand what's happening underneath the increase in bond yields, right? So the increase in bond yields is fairly obvious to everyone, and now we are talking about what you call the longer for higher theme in bond yields. Just look at the data plots of Fed. In March, they were expecting US GDP to grow at about 0.3%. I repeat, in March, Fed expectations for calendar year 23 growth was 0.3%. In September, they've increased the GDP forecast for US to 2%. This is true for calendar year 23. This is true for calendar year 24, although the quantum is lower. Higher bond yields is because of higher expectations of real growth rate. not because my inflation prints are getting out of the bag. So let's assume that. And in ceteris paribus, everything else remaining the same, markets react to better growth rates because that sort of preempts higher earnings growth rate. India, now look at it, in the channel through which higher oil prices move in the country. One thing is obviously balance of payment balance. It is becoming more of a risk. It is becoming more of a risk. Plus, please appreciate that even this year we are looking at about 1.2, 1.3% CAD, right? So we have seen a structural improvement in services exports, right? So if I look at the net deficit which comes out of oil and I look at the net service exports, they are close to each other, right? So, and my inflation is far better, my fiscal deficit evolution is far better. So the macros are in place. So and therefore, if I've got a $4 trillion economy now, my ability to absorb shocks with these kind of macroeconomic parameters are better. So maybe if the stocks don't react when the oil is at $95, maybe they react when it is $110, right? So because your ability to absorb the shocks keeps on going up. And there are other limiting factors as well, right? So increase in oil prices also tends to act as higher interest rates and of tax on the consumers. These things happen all the time. You will never ever have everything falling in line all the time. It doesn't happen.
Right, Nirav, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you.
Before we take